There are movements in the financial world that begin not with a bang, but with a whisper. Japan's carry trade is one of them. It has long operated in the shadows, invisible to the average investor, yet critical to the flow of global capital. And in 2025, this silent giant stirs, threatening to reshape markets, unsettle currencies, and test the resilience of economies from New York to Nairobi. Welcome back to FluxFolio Finance, where we decode the undercurrents of money, power, and policy. Today's episode takes you deep into the architecture of global finance, to the heart of something quiet, but potentially catastrophic. The carry trade. Born from interest rate differentials, it is a strategy so simple in design, yet so colossal in effect. For the past 25 years, Japan, home to the lowest interest rates among developed nations, has served as the world's cheapest bank. Borrow in yen where rates hover near zero. Convert the funds into dollars, reals, rupees, or baht. Invest in higher-yielding assets abroad, corporate bonds, emerging market debt, crypto. Pocket the spread. Repeat. In theory, it's elegant. In practice, it became the invisible plumbing behind the global risk engine. And when that plumbing cracks, the entire structure begins to creak. In 2025, the tremor is here. After decades of battling deflation, Japan is feeling inflation's slow burn. Prices are rising, not wildly, but persistently, driven by imported energy costs, a shrinking labor force, and a yen that's lost a third of its value since 2022. The Bank of Japan, led by Governor Ueda, can no longer ignore the signals. In April 2025, they raised interest rates for the first time in years, from 0.1% to 0.5%. It's a modest move on paper, but in the world of carry, it's an earthquake. Why does this matter beyond Tokyo? Because trillions of dollars depend on the yen being free. Because Japanese life insurers, pension funds, and trading houses are among the largest holders of US Treasuries, German bonds, and Brazilian sovereigns. As yen yields rise, even marginally, these institutions begin to bring their money home. They sell. They hedge. They unwind decades of exposure. Already, the signs are flashing red. In May 2025, the yen surged from 160 to 147 per dollar in just 2 weeks. The Nikkei 225 dropped 6% as repatriation flows gained momentum. In the United States, 10-year Treasury yields spiked to 5.2%, a direct response to Japanese institutions trimming their holdings. In emerging markets, the pain is acute. Turkey's bond yields jump. Brazil's real depreciates. Vietnam sees $3.4 billion in outflows. This is no longer a Japanese story. It's a global liquidity event. In the cryptosphere, the ripple becomes a wave. Much of crypto's leverage, DeFi lending, perpetual futures, arbitrage trades, was quietly funded via FX swaps and low-yield fiat borrowing. When the yen tightens, these liquidity lines vanish. Bitcoin dropped 14% in mid-May. Ethereum saw 1.8 billion in liquidations in 48 hours. Even Tether briefly lost its peg under redemption pressure. The carry trade wasn't just fueling bond yields. It was funding the illusion of infinite liquidity. Meanwhile, the US faces its own reckoning. In 2025, Washington must refinance $7.6 trillion in maturing debt, 31% of all marketable treasuries. Japan is the largest foreign holder of this debt, with $1.1 trillion on its books. But with rising rates at home and a stronger yen, the calculus has changed. They're no longer automatic buyers. They might even become sellers. Yields climb, bond auctions weaken, and with the Federal Reserve already stretched from past tightening cycles, the US finds itself vulnerable, not from a political crisis, but from a capital shift thousands of miles away. History has taught us this lesson before. In 1998, the yen's 15% surge helped unravel long-term capital management. In 2008, a sudden carry trade unwind magnified the global crash. In 2020, as COVID-19 froze markets, Japanese capital rushed home, triggering EM volatility worldwide. Each time, Japan didn't trigger the crisis. It simply reclaimed what was already its own. So where does this leave us in 2025? The Bank of Japan is walking a razor's edge. Raise rates too quickly, and they ignite a firestorm in global markets. Move too slowly, and domestic inflation could spiral, dragging the yen further into crisis. Meanwhile, hedge funds are deleveraging, central banks are intervening, and volatility is no longer a threat, it's the baseline. And yet, beneath the fear, there is a strange clarity. Maybe this is necessary. Maybe the world needs to detox from decades of free money. Maybe this is how we kill zombie assets, reprice risk, and rebuild something stronger. The carry trade, like all great financial tools, was never meant to last forever. It was a mechanism born of imbalance, a world where Japan's silence created global noise. Now, that silence is breaking. The movements are subtle. A 0.25% hike here, a basis point shift there. But their echoes resound across continents. From Wall Street desks to Nairobi banks, the tremors are felt. Because when the yen moves, money follows. And when money moves, the world changes. So here's your FluxFolio playbook for 2025 and beyond. Watch the yen. It is the world's most important signal. Track Japanese repatriation. It may break the back of US bond stability. Be cautious in emerging markets. They are the first domino in every capital flight. And never forget, leverage is a beautiful lie until the funding turns. Sometimes the loudest crashes start with the quietest signals. And sometimes the smallest rate hike in Tokyo becomes the loudest scream in New York. Thanks for watching FluxFolio Finance. Subscribe, like, and tell us. Is this the end of the carry trade or the beginning of a monetary realignment? Until next time, stay sharp, stay global, stay ahead.